Good afternoon, everyone, and thank you for joining. Just as an introduction, I'm Josh Levy, Chief Executive of Ultimate Finance. Absolutely delighted you could join us today for the latest webinar in our series. It's a very important topic we're going to discuss today around debtor protection, or otherwise known as trade credit insurance. As many of you would have seen in the last couple of weeks, the government have recently put in place a reinsurance scheme that provides a guarantee for the trade credit insurance industry. The benefits of debtor protection are vast and hopefully understood by a number of you, but will be covered in a bit more detail later, as well as providing cover against late or non-payment from customers. Having a debtor protection policy allows businesses generally around the country to have greater access to flexible working capital funding through invoice finance facilities. It's used by many thousands of businesses of all sizes, and a large number of our invoice finance clients, some of whom I'm pleased to see have been able to join us on this call today. Over the past few months, it's fair to say we've seen an inevitable reduction in appetite from insurers. Two primary reasons, really. Obviously, the economic impact of COVID-19 that we're all feeling, and also the general expectation of increased levels of insolvency as a result. And this has led to cover being withdrawn or limited in some cases. So the purpose of the scheme we'll go through today is really to enable insurers to continue supporting business-to-business trade, which does rely heavily on the provision of credit insurance. The recovery of the economy, I feel quite strongly from where we are today, will be dependent really on the ability for businesses to keep trading with one another with confidence. Credit insurance clearly provides a level of certainty and comfort to facilitate that trade, and when you combine it with invoice finance, you get a double whammy. So invoice finance to provide the cash flow support really to facilitate the return to more normalised trading levels without complete pressure on working capital balances. Given the vast amount of noise generated by all of the government support schemes with all the different acronyms, we thought it would be very useful to break down the key messages behind the credit insurance scheme, and also go through some of the practical implications for your clients or for your business. And so I'm absolutely thrilled to introduce three others on the call today. Firstly, Alice Smith of Ultimate. Alice leads and manages our debtor protection program with EULA. And secondly, Shaun Purrington of Avenue Insurance Partners. Avenue is an independent insurance broker we work very closely with to provide support for our clients outside of our internal program. And last but certainly not least, Sarah Gillingham of EULA, our key account manager and someone very much at the heart of the government scheme and its application. On the right hand side of your screen, there's the ability to send in questions throughout this webinar, and we'll come back to those questions at the end. For anything specific relating to your individual policy, please leave your name and Alice will contact you or your relationship manager as required following this webinar. Thank you. I'll now hand over to Shaun.
Thank you, Josh, and good afternoon to you all. Thank you very much to Ultimate for the opportunity to share some insights into this new government scheme. It's always a pleasure to share good news, and what we're seeing here now is a recognition from the government as to the importance of trade credit and trade credit insurance to the success and the successful recovery of our economy. The first point to make is that this news originally broke on the 4th of June, so not even 2 weeks ago. And since then, many insurers have been working through the finer details of the scheme and trying to translate this into something more meaningful, into practical steps. And the aim really is to bring back as much risk coverage as possible. So as a broker with access and experience of working with all 13 or so UK credit insurers, I can tell you that EULA is the most advanced in preparing for the implementation of this scheme. And they've probably been also the most vocal in getting government to listen about the need for support. So it's great to have them here today in the form of Sarah, taking you through some of the detailed points on implementation. But that said, it's still very much work in progress, and new detail may emerge, particularly on the scheme design over the next few days. The government is currently seeking approval from the EU to proceed, but there's no real issue seen there. Bear in mind that the French and the Germans already have a similar but not identical scheme in place and up and running. So what we know is that credit insurance is all about facilitating credit through the supply chain. Credit insurers can provide a lot of confidence to companies and trade financiers like Ultimate, because they know that if there is a default, an insurer will respond and make good most of the loss. The good news is that in normal terms, credit insurance really works silently behind the scenes. But in exceptional situations like this, like the COVID situation, where you see big spikes in credit risk, the mood changes, and quickly too. So you can see from the slide the importance of insurance in numbers. The figures that have been mentioned in the various press releases talk about an estimate of insurable trade of £350 billion at any one time, covering 630,000 companies. And that really means that we know 20,000 companies are insuring against the risk of 630,000 companies going bust. So what we know is that the pandemic has dramatically reduced the amount of exposure all credit insurance are able to accept on their balance sheets. The risk environment was already very heightened prior to COVID. Issues like Brexit, the trade wars, geopolitical showdowns, and general forecasts of a slowing economy and rising insolvencies were weighing heavy with the insurers. COVID then came along and just changed the whole risk and reward balance quite seriously, quite substantially. And one way of looking at this is the way that some people describe credit insurance really as bookmakers taking bets on which companies will survive and which ones will default in return for a wager, which is of course the insurance premium. With COVID, quite frankly, many bets were off, and no insurer or even a reinsurer could underwrite and be profitable given the number of and expected value of claims in the pipeline. To give you a sense of perspective, insurers will expect to pay in a bad year around about 500 million of claims. Even with these stricter underwriting parameters, this is likely to increase. Best estimate is somewhere around about 1.2 billion. And then on top of that, if you thought that the insurers could have potentially done nothing, the losses would have amounted to, I believe, around about 5 billion. That is unsustainable. And these sorts of financial numbers would have no doubt played a part in bringing the government to the table with regard to state support. So anyway, big success. The government has decided to intervene and intervene through a reinsurance arrangement. So it's very different to the very overt packages that you see from government to support businesses, CBILS, bounce back loans, because it does come in the form of this reinsurance support. It's very much behind the scenes, and it doesn't really affect the day-to-day interactions between a policyholder, a funder, and the insurers. And that is a good thing. So moving on to the next slide, we can see that the government is prepared to step in with £10 billion worth of credit guarantees. And that's designed to represent 90% of the credit risk that the insurers will take under this new scheme. So de facto, the insurers will retain 10% of that risk for their own balance sheet. In return for 90% guarantee, the government will require 90% of the premium that is being charged in return for that guarantee. The state will then, in return for that premium, commit to maintaining that extensive credit coverage that clients need. The other factor to bear in mind is that, and a positive factor, is that cover will be backdated until the 1st of April 2020, where it can. And that's very positive because it means that cancellations and reductions since that date, and the majority of reductions and cancellations did take place in sort of April and May, will be potentially reinstated, which is absolutely great news. The scheme will run until the end of the year, but there is a review point, a checkpoint in September, and both parties, all parties, might decide to continue with the scheme. I guess it depends very much on the experiences to that date and very much what the outlook is for the economy at that particular time. Now, the scheme applies to all UK policyholders, and it applies also to not just existing policyholders, but also new policyholders from here on in to the end of the year. That's important because what we find is that some companies, some organizations believe that they no longer need a credit insurance policy because they think the state are now going to cover all bad debts. And of course, that's not the case. You do need to have a UK credit insurance policy to benefit from the scheme. So essentially, the insurers are a conduit for the government in terms of providing this extra exposure. Now, insurers don't have to participate. It's voluntary, but we expect that most will. We know that, of course, EULA are being involved and have signed up, Atradius too, and also COFAS. So that's essentially the big three all looking to participate. We've heard that the other insurers are going to make announcements imminently. So watch this space, as they say. Another important aspect, and again, more good news, is that insurers will not pass on the cost of the extra government scheme directly to the policyholder. We believe that that is probably a mandate from the government that essentially the insurer will not increase policy premiums mid-term, although some of you will know that prices are increasing in the market at large, really since the end of last year, to reflect the greater risk that I mentioned earlier. And finally, from me, before I pass over to Sarah, a very important point. The government scheme is not a magic wand. It doesn't overnight turn poor, difficult, challenging credit risks into risks that a credit insurer and therefore the government may wish to write. Insurers have been told to maintain good underwriting discipline, and the emphasis really is on making sure that risks that have been scaled back, removed because of COVID-19 should be reinstated and at least reconsidered. So in other words, if the insurer had poor financial information, adverse information, overdue information, it's unlikely that by following the scheme to the letter, which is maintaining underwriting good discipline, being mindful of the fact that it's COVID-19 that is driving this scheme, things won't change. Things won't change. So one example might be a retailer in CVA had limits withdrawn. They won't be reinstated under the scheme. So not a magic wand, but nonetheless incredibly good news. That's it from me. I'm going to hand over to Sarah to take you through some of the practical implementation measures.
So I was going to give you a bit of background about EULA and how we underwrite generally first. So EULA Herms is I work for EULA Herms and I look after Ultimate Finance Group as one of our clients. I've worked at EULA for 17 years and Ultimate Finance have been a EULA client for about 6 or 7 years, I believe. EULA are the biggest credit insurer within the UK. We've got the biggest market share. As you can see, we've got thousands of customers across the world. We're also part of the Allianz Group, so we've got a strong backer as a parent company as well. And we're rated well by S&P as well. I do believe the other credit insurers on that list, I know Atradius have signed up to the government scheme, COFAS have as well. I believe HCC have, but I'm not sure about the other smaller entities. On to the next slide, and this gives you a bit of an overview as to how we underwrite risks generally. So we've got a worldwide database. So if you're a UK client and you're exporting to Brazil, for example, all our UK underwriters have got access to all the same information that a local underwriter in Brazil could see. We use publicly available information on limited companies, so the accounts that are filed at Companies House, CCJ information, but you know, EULA's biggest unique selling point is our risk office network, our specific information that we go out to your customers, to clients, to buyers, you know, to big PLC companies, to anyone out there, to get information that's not in the public domain, to get the management accounts, to be able to sort of take a view on that particular risk. So we're not using information that's 12, 18 months out of date. We're using management accounts that's as recent as we can get. So onto the scheme specifically, onto the next slide, it gives you some overviews and background as to how it will work. So any action we've taken, the UK didn't take any mass action on limits. There were other business units across the world who did take mass action. So any export limits that have already been impacted by any mass action, they will be reinstated automatically by us, and we can identify those. So any clients' policies that have had these mass action impacted on the export limits, they will be put back, and we're hoping to do that this week. So clients don't need to do anything on that. If a limit has been reduced specifically following a review of a buyer that we've done, clients need to reapply for those themselves. So we're not putting those back automatically, one, because we can't tell which ones sort of have been reviewed and which ones you might need back. We're taking a demand-led approach. So you tell us what cover you need. It might be back to the same level that you had before. It might be to a smaller level. So we want you to reapply for those limits. As I said before, there's no guarantee that every limit will be reinstated. It will be assessed based on the parameters of the scheme. And there are still some details we need to finalise on that as well. It's with the European Commission for sign-off, and we should be finalised early next week. So we would encourage clients to start applying for those limits as of next week. But again, we will feed that back to Alice, who is your contact and who the queries can be passed back to. Limits will be reinstated on a temporary basis. So any limit that has been impacted since the 1st of July, we will put back on a temporary basis until the end of the year. The scheme runs until the end of the year, till the end of 2020. So any limits that are applied for that you put back in up to the 31st of July, so you make that application between now and the end of July, the limit will be backdated to the 1st of April, and it will be on a temporary basis, and that temporary limit will expire at the end of the year, which is when the scheme expires. What we are going to try to do between now and the end of the year is go through all those limits and see which are viable to write on a permanent basis. Again, those details have not been confirmed how we're going to do that yet. I think we'll probably look at that over the next couple of months. But again, our risk analysts and our underwriters will be working to try and get as many of those limits that are written on a temporary basis put back permanently, so they don't all drop off at the end of the year. So there's no cut-off. You know, any new business that you want to put through, there's no sort of pot of cover. There's no cut-off on reapplications. They can be made at any point between now and the end of the year. You just need to reference HMG when you're making that application, both in the narrative and the client reference. But I think Alice is going to give you all the UFG clients some specific feedback on what to do on the applications.
Yes, absolutely. Full detailed instructions on how to apply for those will follow. Sarah said obviously next week we're hoping to start applying for those. If it is that date, we will come out and let you know.
A few questions, Sarah, that have come in, and that's been very helpful. Thank you for doing that. It's probably worth just explaining one about the cost implications for anyone using a policy as a result of the scheme, and also the importance probably of why it's just applying to the actual utilised portion of the requested limit, rather than I guess what's happened in the past where a limit's been applied for and not all of it is necessarily needed today.
Mm-hmm. So the first question on cost, there is no cost to clients. So the scheme is very similar to the German scheme. It's a reinsurance scheme. When at the last recession, I believe the government brought in a scheme that was too little too late. It was very expensive. This scheme's very different. So there's no cost that is being passed on to the clients, to UFG. It is the credit insurers will be given 90% of their premium to the state, to the government, which means they will then, they will be paying 90% of our claims. So the reinsurance, they will be reinsuring it. So there's no cost to any clients. And your second question, Josh, relating to the cover that's going to go back. When as with any review we do, we always find that when we reduce or cancel credit limits, sometimes clients aren't using them. It may be a quiet time of year. It may be that was a one-off transaction that they needed the limit for previously. It may be just that, this time of year and what's happened over the past few months, the trade may well have reduced anyway. So we're not, we want to put back the limits that clients need. We don't want to put them back at the level that they were previously. If you need them at the level that they were previously, then please make that application for that original amount. But as I said, it's a demand-led approach. So we need clients to tell us what level of cover they need us to put back.
And will you be asking for any additional evidence to support that request?
Just if you could just tell us what outstandings you've got, and literally just a couple of words. We just need HMG and outstandings, say 25 grand. Just a couple of words to almost justify if you're asking, for example, a £1 million limit and your outstandings are only 100 grand. We would maybe question why your limit application is so high. So you could maybe give us a little bit more background. Is there a large order you've got coming in? The most essential thing is just a HMG narrative, because we need to track how many limits we've written that are under this government scheme for our reporting side.
Brilliant. And another question just around the temporary wording that's been used. So I think you explained the scheme in principle lasts until the end of this calendar year. What happens after that, do you think? I know that's a bit crystal ball.
There is a review point in September. So we have said the government wants us to look at where we are at in September. I assume at that point we'll look at the credit limits that have been approved under the scheme, look at where we are in the pandemic generally, how the economy is at that point, have businesses reopened, are things back to normal. So at that point in September, we'll review it, and that it will be decided then whether the scheme will be continued past the end of December into 2021, or whether it will end at the end of this year.
Thank you. So Ultimate are accredited as a CBILS lender, and one of the things we've been talking about during our discussions with introducers and prospects is turning back time. So CBILS enables us to look at a client's creditworthiness essentially at the end of December 2019. Does this scheme work in a similar way when you're looking at new business limit requests?
Sorry, just clarify what you mean by looking at new business requests. So new limits that your clients are applying for?
Yes, I'm guessing. Do you look at it within the scheme parameters, and does that enable you to write cover that you wouldn't otherwise have done 2 weeks ago? Yeah,
potentially. It's not just for limits that have been cancelled and reduced for existing clients. If new clients come on, and potentially if there's a business where you know, it's been impacted by COVID, and under, you know, this time last year it would have been a viable risk and we would have written that limit, and then potentially under the government scheme we could write a new business limit under the government scheme as well. It doesn't necessarily have to be one that's been withdrawn or cancelled previously. We could look at it, we can look at new limits under the scheme as well.
Got it. A question come in, when looking for the limit, there doesn't seem much space in the box to put HMG and other information.
There is a character, there is a maximum on the characters. Let me just,
I think the box extends further, so there's a box on there that says add a narrative, and then another box would appear, but once we get round to obviously applying for these limits, I will send full detail instructions out to clients to let you know how to do that, and if we are struggling to get the information in, then I can obviously feed that back as well.
Thank you. And the scheme starts as of the 1st of April. How about limits that were cancelled prior to this? Does the scheme cover anything to do with that, or is it separate?
No, it doesn't. But if the, you know, again, we're always happy to review limits if they have been cancelled prior to the 1st of April. If there's new information, or if you believe that the risk, you know, the risk stance will have changed on it. I guess the 1st of April was used because the lockdown started at the end of March. It was at that point that businesses closed and sort of everything stopped. So that's why we used the 1st of April, or that was the agreed date that the government have decided on. But we can look at ones prior. It won't be relevant under this scheme, but that's not to say we can't look at decisions that were made prior to then if there's no information.
Brilliant. And high risk sectors, so things like tourism, hospitality, travel, is there anything relating to specific sectors that is worth saying, or is it not excluding anything in particular?
No, we're not excluding specific sectors. I still think we class those sectors, specifically the ones you've mentioned, as high risk, but there isn't, the government scheme isn't for certain sectors, so there won't be anything that's excluded on the scheme.
Got it. And where a client or a business is trading with a buyer that's been closed through the lockdown period, will you write limits on those buyers only when they start trading again?
Good question. I think they could potentially be meet the criteria under the government scheme. They've specifically closed for a COVID-related issue, and that is the whole point of the scheme, that it's for COVID-related businesses that have been impacted by the pandemic. So again, I would say, I mean, each limit is going to be looked at by an underwriter on a case-by-case basis. So I suppose we have to look at the criteria of the scheme and, you know, the viability of that business being able to, as I said before, it doesn't make a bad risk into a good risk. So we're still looking at the viability of that business. But if the previous decision was COVID related, then yeah, potentially we could put the cover back under the scheme.
Great. And can people still use the cap scheme?
Yes.
So this
they
doesn't
can.
cap. Okay.
We have also relaxed some of the rules on that as well. So cap is now available for all sectors. You can also cap a temporary limit as well now, which you weren't able to do previously. But again, if you want more specific information on that, then speak to Alice, because there has been some new feedback that's come out on that in the last few days, I think.
Got it. Thank you. I think that's all of the questions we've had in. I guess just as a summary from my side, this is a massive support scheme for the economy as a whole. Credit insurance is rightly seen as playing a big role and a big part in ensuring economic stability and also their confidence to continue trading that I talked about before. Clearly, it's a big part of our support package for clients and new business because the provision of debtor protection and credit insurance gives us a lot more comfort and confidence when we're looking at invoice finance facilities, and it's part of the protection you get as well as the funding. It goes far beyond that. Clearly, one of the natural implications of an economic downturn is causing underwriting decisions to be impacted, and we had seen that. EULA were one of the few that didn't take mass action, and that's much appreciated by us and our clients. Other insurers did take a much harder and earlier stance, and they're having to backtrack through that. Clearly, the intervention, as you've heard from Sarah, really enables insurers to continue providing cover at pre-COVID-19 levels where the trading limit was required, and that's the purpose of this scheme. So look, any questions specifically to your policy, please go through Alice or your relationship manager and we'll come back to you. And that's been really helpful. And if any further questions for Sarah, please send in by email. We can cover off. Sorry, I have actually just had one question come in as I was saying, Sarah. So this question: what do underwriters deem too old for underwriting purposes? Just thinking that the government allow companies extension to file their accounts.
I wouldn't say there was a general rule on that. We have taken note of the extension in filing. If you're looking at someone like Tesco's or Amazon, there's going to be less of a concern that they don't file their accounts on time. But if it's a small SME business who's likely to have been impacted by what's happened, and if they've been closed, if they're in one of those high-risk sectors, we probably will be asking for up-to-date financials to continue writing that risk. But again, if it falls under the government scheme, it's almost exempt because we'll be writing the limit almost regardless, because it'll be under the criteria of the scheme. We won't be asking, what I mean is we won't be asking for X, Y, and Z for it to fall within the scheme. We won't be asking for up-to-date financials if they are of a certain age. So we'll be looking to write it regardless. But I think if the question is outside of what's going on in the government scheme, there isn't generally a hard and fast rule. It depends on the buyer. I know that's a bit of a cop-out answer, but it is case by case.
Brilliant. Well, thank you for joining us, Sarah, and thanks to everyone for joining and dialing in for this. As I said, any further questions, Alice will be very happy to help and to support. Thank you.